So tell me what you got on the board today, what you're looking at, you want to discuss, and then
You know,
we'll
I want to talk about the Fed, Larry. And less, well, and more the things that are affecting the Fed rather than the Fed meeting itself, right? We talked a little bit about last week's Fed meeting last week on Saturday. But I think that the Fed has a couple of interesting things going on that I think the market is coming to grips with. And so you and I have been excitedly watching rates drop from 8% to 6.5%.
yeah, it's not like I predicted that or anything.
However, we've seen an increase over the course of the last couple of weeks as things have started to shake out here in the first quarter. The most important is, look, everybody lowered rates aggressively because bond traders were of the belief we were going to see rates get lowered by the Fed, the rate they control, in March.
Right.
The economic data we've seen so far this year says that's not happening. Whether that's
it's definitely not happening in March.
Right. That's a January jobs figure that we talked about. There's some inflation figures in the CPI, et cetera, et cetera. We're really seeing some stickiness. The other issue is the supply and demand of debt. So today, in an hour, we're going to get information as the Fed is selling $42 billion in 30-year bonds. And if the market doesn't absorb those well, we could see higher mortgage rates in an hour and a half than we have now. Now, if it does absorb it well, we'll see them higher. But usually when more supply comes to market, the supply and demand equation in life forces the price higher, right? And so at the end of the day, or the price lower and the rates higher, really, to be most accurate. So I wouldn't be surprised if we continued to see a trend towards higher rates, not that we're going back to 8%, but that the run lower, and I did predict this, didn't I? When I said we're not going on a straight line to under 6% from 8%.
Of course not. No.
We're going to bounce back a little. Rates will be a little higher. We'll see where things will shake out. And you remember me saying at the beginning of January, if this works for you, you should go get it because you don't know what's happening later.
That's right.
And that's very much in play currently. So, we have a bunch of clients, and really not just clients, but if you're not a client of ours and you want to talk about this sort of thing, if you bought a house in the last half of 2023, the opportunity to grab more affordable financing may be available. And I was talking with very specifically with a client last week. He's like, yeah, I saw 6.5, but I'm waiting for 6. I'm like, dude, I don't think you should, right? Like you can save $260 a month. I mean, he was the one guy, he closed the highest in August, right? Like he closed at 7.8, 7.5 or something.
Yeah.
I mean, it was as high. And so the thing is that there are lots of ways to structure your refinance, especially in Illinois, which is a low-cost refinance state generally, right? You usually refinance for less than a couple of grand in hard costs. And so if you can turn around and save $260 a month and it costs you $2,000, you're even in less than a year. Yeah. And so you should do that because you can always refinance again later. It's not necessary to try to guess the bottom, because if you try to do that, that's a fool's errand, as we've seen over the last couple of years, but especially as it relates to the economic news that we're getting.